The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, joining us now on the program as we continue our year in review of what's been happening in the markets for 2024, looking ahead to 2025. Also, we want to take a look at a recent elevator report published by CoBank's Knowledge Exchange. Here to talk about that and have a conversation with us. We always appreciate time with Tanner Emke, lead economist for grains and oilseeds at CoBank. Tanner, it's good to catch up with you again. Merry Christmas, happy holiday season to you and yours. Thanks for joining us.
Yeah, great to be here, Jesse. Good to see you.
Let's start with this latest CoBank report, elevator report, and just give us some thoughts here. This was kind of a corn, soybean elevator outlook, and it seemed from what I was reading, plenty of this kind of goes with the overarching themes we've seen in this grain market and the ag economy in general here this year. But give us the down and dirty and some of the background here on this report, Tanner.
Yeah, so we take a little bit of a different look at corn and beans. Obviously, prices are down at four-year lows for both corn and beans. It's no surprise to anybody who's been struggling through that. Especially with production costs on the farm having been fairly resilient. So that's no surprise there. So we took a little bit of a different tack, and we wanted to talk about the profitability of storage. And that's really impactful for CoBank's direct customers that are in commercial grain storage. And that's predominantly your grain elevators. And from that vantage point, we've got a lot of supply out there. Obviously, we had the second biggest corn and bean crops on record, a lot of carryover supply from last year's big crops. So an immense amount of supply in the United States. At the same time, we have big crops coming from South America. At this point in time, it appears as though we will be having record crops in Brazil and Argentina combined. Because the weather there is looking decent. It's a big improvement from where we've seen earlier this year as they were heading into planting season. And so what the market is dialing in here is just the immense amount of supply that the world is dealing with at this point in time. And so what does that mean for storage? Well, how do you measure profitability on storage? You got to look at the spreads. And what I mean by that, you look at the deferred contracts, like the March 2025 contract, versus, for instance, on corn, the December 2024 contract, and you take that difference and you track it over time. And what that tells you is what the market is paying you to keep that crop in storage. And clearly there's been a trend over the long haul of the market incentivizing storage. So although the flat price may not be very appealing at all, there is an opportunity for capturing profit on those spreads. At the same time, we're also seeing an opportunity perhaps on lower buy basis if you're a grain trader to buy some weaker basis if indeed we see record crops coming from South America. But as it is at this point in time, Jesse, we've seen a narrowing of the spreads. Which is odd when you're given this immense supply situation we've got here in the United States. And that's because the market is doing its job from low prices, stimulating very strong demand. We've got very strong exports for corn, wheat, and beans, all three. We've got strong exports. We've got strong domestic usage. And so the market is accomplishing its goal of whittling down those inventories through low prices. And so that's pulling the spreads in at this point in time and tightening the basis. Longer term view here, we think that's going to reverse. We're going to see a return back to widening those spreads, therefore more profit on storage and a weakening of that basis for corn, wheat, and beans.
Well, and to that point, a lot of the concern here about potential new tariffs and more with the incoming Trump administration, and you led me right to what I was going to ask you next is, could we see this all flip on its head depending on what the trade policy looks like here moving forward? I think it's a lot of what ifs right now, and we might get some more answers here in just a matter of weeks, Tanner.
Yeah, I think you really pinpointed it there very well, Jesse. A lot of what ifs. We don't know how Trump plans to use tariffs, how long they would be implemented, to what degree. We don't know how countries would retaliate. There's just so many unknowns at this point in time. That being said, if we were to enter into a trade war with our major trading partners like Mexico, that's the top destination for our corn, or with China, that's our top destination for soybeans. Also point out Mexico is also our second top destination for soybeans. Those are our two most important export destinations. This would be happening at a time when the dollar would be strengthening, making our exports more expensive. That's our forecast, that we'd continue to see a strengthening of the dollar as the U.S. economy continues to grow. And at the same time, we'd have record crops coming from South America at a time when their respective currencies are also weakening. Okay, so it's really a culmination of a lot of factors there that you'd have to sort out. Is it the record supply coming from South America? Is it a weakening of their currencies? Is it a trade war? There's a lot of factors there that create headwinds, and trying to sort out what would be responsible for a slower export pace would be difficult. But I would say the culmination of those three things: record supply out of South America, stronger dollar, or weaker real, if you will, and then at the same time a trade war that creates a lot of headwinds there for our export programs.
Tanner Emke with CoBank joining us here today on the program. Tanner, with that elevator report, when you looked at corn and soybeans, was there one of those markets in particular that looked to be a little friendlier than the other? I'd have to think, judging by a lot of the talk I've heard in the trade, everyone's a little more friendly corn than soybeans. Was that the case when you guys broke this report down?
Well, both crops are going to have different storage costs. That's based on their price and the interest expense used to store those crops. And so the profitability on each one of those is going to be different. So the way we looked at it was the cents per bushel per month. So we took the spread between Dece corn to March corn, divided that by 3 in December, January, February, March. That's 3 months. And then January to March soybeans. That's 2 months. And then that's how you end up with that calculation. And that they both kind of trend in the same direction, because the demand, as I said earlier, was strong for both. Really, the cost of storage then is going to depend upon each individual grain elevator or grain merchandiser on their interest rate and how their debt is structured. So that would really be up to the individual co-op. But both, at this point in time, both crops were trending in a direction where the spreads were narrowing because the demand has been so strong. But for both of those crops, I would say the demand is going to be slowing down at the export front. And plus, they would both at the same time be seeing more competition from South American crops for corn and soybeans. And so the spread's widening for both of those crops once we head into the new year.
What about feed usage? You guys looked at that a little bit in this report too, and I can't forget about our folks in the livestock and the animal industry here, just looking at, whether we're talking cattle, hogs, chickens, you name it. I know that feed margins with lower grain prices have been pretty good for folks on the animal ag side. Talk about that a little bit, Tanner.
Yeah, excellent point there. There's a lot of positive story here in agriculture, and that's mostly coming from the livestock side, as you mentioned. Whether you're talking beef, pork, dairy, or poultry, the feeding margins are positive because grain prices are down, and so as a result, that bid is a lot stronger. They're going to be a consistent bid out there for grain because their margins are a lot better, and so they're going to be bidding up that grain. And if we see a slower export pace materialize after the new year, I think that's going to be a positive, or the stronger bids from the livestock center are going to be a positive story here if we start to see a slower export pace. Now, we point out in the report that we don't think that livestock usage is going to make up for any loss of exports or a slower export pace, but it will be a positive story nonetheless. And that's really been the case here for quite some time out on the plains, where you've got very strong feeding margins. And out on the plains, they've really been very strong bidders for grain. And so we see that going forward, where if we see a weaker export bid, that's going to allow more of that supply to migrate west to the plains where you're feeding a lot of cattle.
Talk to me about the wheat markets just in general a little bit here, Tanner, as we close out the year. I know you guys didn't look at that in this specific report, but obviously I know you watch wheat quite a bit, and both domestically and globally. Wheat's been, just kind of churning around here at low prices. Hasn't been a really friendly market, I guess I would say. What's your perspective on wheat as we close out 24 and look ahead to the new year?
Wheat's been balancing on a tightrope between a number of factors. You've had poor growing conditions in the Black Sea region for their winter wheat crop, specifically for Russia and Ukraine. Although they have received some rains, we're not out of the woods yet for that part of the world. We had sizable Southern Hemisphere crops, especially with Australia and Argentina didn't do so bad as well. And so you've got that push and pull here of supply and demand, where the market is trying to figure out where especially supply is going to be when you've got ample supplies in the Southern Hemisphere versus concerning situation developing in the Black Sea region. Then, of course, we had bigger crops here that the market is trying to move into the export market. And then at the same time, a big influence on wheat is the value of the ruble. And the Russian economy hasn't been great. And so the value of the ruble has weakened versus the dollar. And so that's been another anchoring factor there for wheat. And so wheat has kind of been stuck in this push and pull, if you will, trying to find some price direction. And I think by the time we get into March, we're going to have a clearer viewpoint of where wheat's going to go, specifically because we're going to have a better idea of the condition of the Russian crop. Between now and then, the market's really just going to be caught between corn and soybeans, I think, and trying to figure out also the situation of the U.S. crop as well. We've got some nice ample precipitation on the plains, and that's really helped out the HRW crop there. So that's been some positive news as well that's been anchoring prices.
Tanner, as we look ahead here too, I think about January's WASDE report from USDA, traditionally a big report to kick off the year. And just thinking about these grain markets in general, what's your perspective heading into that key report here as we get set to start a new year?
Well, following up on what USDA said in their December report, where they slashed December corn stocks by 200 million bushels, I'd anticipate they may have a little bit more in store as they dial in this very strong demand, especially record ethanol demand and a very strong export pace. They may have more yet to cut on stocks for corn. For soybeans, I think there's more to do on what they did with the soybean oil balance sheet. They dramatically increased exports there, but I don't think they were. I think USDA was fairly cautious, even though they increased soybean oil exports by about 45%, and that was long overdue because what we have on the books for export sales still exceeds or is still already with 38 weeks or 30 some weeks yet to go in the marketing year. We still have more yet to go. So I think USDA is going to be cutting or increasing export sales on soybean oil. And on wheat, I think there might be yet perhaps another revision on exports there as well. But I think I think the eyes are going to really be on what happens with the soybean balance sheet and with corn exports and domestic usage.
Well, as we close it out here today, Tanner, final thoughts from you, anything you want producers to keep in mind as we look ahead to the new year in terms of the grain markets? What do you want folks to think about?
If there's any thoughts that we could offer to farmers, trying to evaluate their marketing plans, I would recommend to take a look at a storage hedge. I guess pull a page out of the playbook from grain elevators. That's how they make their margin in a surplus environment. And so that is a big change from where farmers have had to market crops here in past years where the price just kind of came to you. This year, you have to be a little bit more diligent with a sharper pencil. And so I'd say when we've got a surplus environment, see if there's an opportunity there to use a storage hedge for your marketing.
Well, of course, that risk of trading futures and options can be substantial. Always want to remember that. You can take a look at that quartered soybean elevator outlook details under the Knowledge Exchange tab at CoBank.com. That's CoBank.com. And with that, Tanner Emke, lead economist for grains and oilseeds at CoBank. Always good to chat with you, my friend. Merry Christmas. Happy New Year to you and yours. And we'll talk to you again soon.
Thanks, Jesse.
Make sure to subscribe to the Market Talk YouTube channel. There, you can watch our latest interviews with the top market analysts in the country, find bonus content, and much more. Just go to youtube.com/markettalkag and hit the subscribe button, or you can search for Market Talk Ag on YouTube.